Hello, and welcome back to the Rose Bros podcast. This episode, we are joined by Steve Larke, Corporate Director at Topaz Energy, Vermilion Energy, and Headwater Exploration. Steve's previous roles include being an operating partner and advisory board member with Azimuth Capital Management, a managing director and executive committee member with Calgary-based Peters Co, and before that being a vice president and director with TD Newcrest from 1997 to 2005. Steve also has a Bachelor of Commerce degree with distinction from the University of Calgary, a CFA designation, and also holds an Institute of Corporate Directors designation. It was a long-form discussion as we sat down for a smooth cup of Rose Bros coffee and discussed why we need all forms of energy, capital discipline versus wildcatting, destabilizing the energy grid, respecting the balance sheet, and metaphorical balloons. Enjoy! This episode is also available on YouTube, so check out the Rose Bros channel, and if you enjoyed the conversation, subscribe to the channel. This podcast is sponsored by HeadCanadaRacing.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne-Parody, HeadCanadaRacing.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to the customer. Check out HeadCanadaRacing.com for more info and get your high-performance ski gear for the upcoming season. Also, this week's podcast is brought to you by Rundle Eco Services. Looking for a way to recycle your frac pond and pit liners used in the energy industry? Rundle collects and processes liners using an environmentally friendly system, leaving a clean environmental footprint. The end use of these liners are shredded and processed into pellets that can be used and extruded into various forms of usable plastic products, including furniture, various building materials, and industrial packaging. Check out rundleco.com for more details on how you can recycle your industrial pond and pit liners today. Alrighty, well, we can start.
Sounds good.
We're recording now.
Okay.
Steve Larke, you are a retired investment banker. You are on the board of Topaz Royalty and Vermilion Energy. I really appreciate you taking the time to do this.
Thank you.
I was late today also, so I'm sorry.
I am late almost everywhere I go, so that's not a problem.
Before we start, we have to give a shout out to Marty Staples.
Right. So we were introduced by Marty Staples, who's the relatively newish, a couple of years into his game, CEO at Topaz. And, it's just been a real privilege getting to know him and the Topaz team and serving on that board. And it just as it's been a real privilege being on the Headwater and Vermilion boards, in the sense that you get to work with great people who are thoughtful and have great integrity. And it's been a wonderful learning experience on all fronts. So yeah, great shout out to Marty.
Well, I appreciate your time. I know it's valuable, and thanks, Marty. It's a long overdue thanks for all the intros. So why don't we get into your thoughts on energy and opportunities in energy? You're also one of the few people that Neil Rizal would say he goes to for advice. On the podcast last week, he told me that. So
yeah, no, well, thank you for the compliment. And I would say the same right back to him. He's a brilliant guy. So it's a privilege to work with him on the Headwater board as well.
How would you describe yourself?
Wow, that's a random question. Other than short, bald, and funny looking, I think I'm pretty high energy, I guess. And, when it comes to being a stock market operator, I think the thing that has always gotten me out of bed in the morning is mosaic theory. In other words, can you take all the billion pieces of information flying around, create a mosaic, and then realize a way to potentially make money? I find that a fascinating thing to do, and it gets me out of bed in the morning. So that's what keeps me going.
At a high level, how did you get into energy?
Well, I'm a Calgary boy. Came out of university, got a job that I hated, and quit that. Rode my bike across Australia, came back and realized that I kind of wanted to get into the stock market side of life. I traded with one of the banks for a while, and then I ended up hooking up with a fellow by the name of Tom Ebbern, who is a geophysicist, and he and I crafted a research product together over a number of years, working at Newcrest, which was acquired by TD Bank eventually. And that's kind of just how it started. It wasn't it wasn't intentional. I think it was just based on where I grew up.
Did you always want to be an investment banker?
Well, investment banking, I've actually never, there's three stools, right? There's corporate finance, which are the investment bankers. There's research and equity sales and trading. And so I've done the research and equity sales and trading, but I've never been a true corporate finance guy, although a big exposure to capital market side. And it's been a fantastic, fun, intellectually stimulating, periodically incredibly frightening career. And it's been great. But, did I really set out to do that? Didn't really know when I was young.
Always in energy, riding the highs and lows.
Yeah, that's right. There's no shortage of taking risk. And I suppose, I was listening to your podcast last week with Neil of Headwater and talking about the entrepreneurial side. And that's kind of where I have benefited and put my chips. Like small partner in Newcrest Capital. We were acquired by TD Bank. And I realized at TD Bank over time that working at a big entity was very challenging for me, just in the sense of, little fish, big pond. And so when Peters Co invited me to come over, it was with, great joy that I was back in a small shop that felt like I could make a big difference at, hopefully, and tried really hard to do that.
Lots of people like to say they called the energy supply crunch in 2018, but not many people actually wrote about it and published a paper. You did.
Right.
What were you thinking at the time? Maybe in high level?
Yeah. So for background, I guess there's a young fellow that I worked with on that piece, Adam Ledane, and we were, and I still am, concerned at the level of self-flagellation, I suppose, of Canadians over their energy business. And when you really sit back and look at how important the energy complex is from all perspectives. And I guess one of the things I tell you, like in 2017, we did a bunch of research and this, that, and the other. And my primary conclusion was that you need all energy types. So, we talked about this morning. Like I'm on a handful of oil and gas company and related boards, but I am not biased against any type of energy because I think we need it all. And, everyone needs to get better and do a better job. But the genesis of that piece was pointing out how we're blocking investment in key energy stuff, infrastructure, production, whatever. But the way humanity was evolving in so many different directions, starting with your iPhone and how, pressing a button turns on a power system that's enormous. We can get into that if you want to, but energy demand seems to keep going, and we need to deal with that, or we're going to run into all sorts of societal problems. And so, I'm not against wind, solar, or anything. I think we need it all.
That was 4 years ago now.
Yeah.
That was before COVID, before everything.
Yeah. So, okay. So you just complimented me in the sense of I made a call, but let's not forget that oil went negative first. I did not, you know what I'm saying? Like it's, people can brag about their forecast, but they're wrong all the time. I mean, I have a CFA designation and sometimes I feel like can't forecast anything is probably how it should come across. But in any event, that you can see these things coming, and it's part of the mosaic theory. And I would say we're in the same place today, and it's curious and concerning and exciting. And I feel like as an investor, there's places we can make money, and we can walk through that. But it's your podcast; you can ask different questions how you see fit.
I like to keep things pretty high level and simple for the listener, but I guess to go back to your call in 2018, the idea was that there wasn't enough energy supply and that prices were going to go up for things like oil and gas in very simple terms.
Yeah. So in simple terms, right? So you don't want to put too many numbers out there, but by my math, I call it the US oil Ponzi scheme, the shale oil Ponzi scheme. And so the big four basins spent $800 billion and didn't have a lick of free cash flow. Okay. So investors were rightfully upset. Not only that, but you pile on the ESG movement and the political movement away from CO2 emissions, which is all fine. But what it does is it starts restricting capital in a big way. Over the decade that I was talking about, US companies spent notionally 125% of their cash flow. And now it's a fraction of that. And a different number might be previously we'd spend 400 to 450 billion amongst a group of companies I might look at. And now it's 150 to 200 sort of thing. And so if oil demand is not decreased and gas demand last year was at record levels, you're running into problems. And so the supply is tight. Look, I love Peters Co research. All those guys are former partners of mine, wonderful people. I borrowed their research deck the other day, and then I applied my style of looking at things. And this is perspective. So on 2023, Peters covers notionally 10 million BOEs a day of production. Okay. The guy like me looks at it and says, well, okay, on forecast dividends, share buybacks, and special dividends, you tally that up and put a capital efficiency number on it. And I would say that there's 2.5 to 3 million barrels a day just from those companies that never shows up. That speaks to supply tightness to me. And so it's kind of an interesting time in the world.
You made that call in 2018, but then oil went to zero and then negative.
Yeah, right.
So what were you thinking then?
Well, I was hiding under my desk buying energy stocks, and I really was hiding under my desk because you're so frightened, and you're wondering if you're going to blow up your entire personal portfolio. But when you're trading stocks or investing, or I call it owning versus renting, and there's all these different ways of going about it. But hiding under my desk, buying stocks backward worked out. And so that's what I was thinking, because you knew that no oil company was going to survive negative 40. So then I'm a buyer of that trade. In other words, the supply would collapse at negative 40. And so then you had to pick your guys and say, well, okay, who can probably survive out the other side of this?
Yeah.
It worked out, thankfully, but it was scary. It was a very frightening time.
That's incredible. I've talked about this a few times on the podcast, on the day companies like Vermilion went down to $8 and CNQ and all the rest. And you actually bought those days.
Oh yeah, no. And you're buying some stock and you wake up the next morning and and it's down another 10%, and you buy it and then you wake up the next morning and it's down 15 and you're really feeling sick. Yeah, no, that's tough, but that's where you make the best stock calls or investments that you make are when things look really horrible. And it's a truism, and everybody says they know it, and that's great. But actually doing it at the time is very gut-wrenching, unless you're, a psychopath or whatever, short on emotions.
Dr. Michael Burry or someone like that.
Yeah, exactly. Right. Like someone who really stays disciplined. And I know a few of those guys, and I'm sure they made a lot more money than me.
That's cool.
Yeah.
2018, there was a crunch. We're probably still in a crunch now, but fast forward to today, prices have risen a lot.
Yeah.
What are you thinking now?
Well, oil demand in August was 99.5 million barrels a day. I just mentioned that gas demand was the highest ever in 2021. And sure, we are heading into a recession, I think. We're probably already in one in the US. I think Europe is a shoe-in for recession. I don't know how they're going to get out of that. The difference, I suppose, this time is what I just illustrated, that, 10 million barrels a day of BOEs a day of production is not showing up with the 2.5 to 3 million barrels a day of volume that it could, because it's effectively dividending all that money out. And so I would tell you that I'm a buyer on weakness. In other words, as a stock market operator and a trader, and there's real volatility here. And so I'm a buyer on weakness. Am I going to chase it up? No, I don't think so, because the volatility is crazy, but that's how I would phrase it. But picking an absolute number, I have no idea. It's not a safe thing to do.
Oil and gas is a commodity. It seems to follow the same old supply and demand curve. Price has gone up now big time. We were at $100 a month or two ago. Do you worry that we're on the way down now, or is there a new supply bottom, pricing bottom?
I'm a little bit of the view that it's probably a higher for longer type price, and maybe we have an economic cycle where the oil drops to 30, 35 or something for a little while, but it won't stay there for very long. And when you consider the absent capital that is not adding to supply anymore, in previous cycles, companies overspend their cash flow, growth at all costs, And then as the economy starts to turn, the oil price collapses because the marginal barrel, there's just way too many of them. And so now I feel like even if you have a recession and a bad one, let's pretend it's a really bad one, and oil demand drops, the oil price won't stay down for very long. And as the economy does start to recover in whatever fashion it recovers, you're just going to be in a tight supply situation again. It's different than before in the sense of, I know that it's weird. The day-to-day volatility is higher because everything is tight and liquidity is down, but the supply inelasticity is much greater than it used to be. You're just not going to add 2 million barrels a day like the U.S. was adding in the last decade. It's not happening ever again, I don't think. The capital's not there. Investors don't want it invested. So maybe if oil goes to 150, that's enough of a price incentive to get people to start spending more. But I think there's all sorts of other challenges that come with that.
Why isn't the capital coming back like it used to?
Yeah. So, you think about the evolution of capital markets and you say, well, I would tell you that they're still very negative overall.
Towards energy?
Towards oil and gas. You can see it. So let's look at the positives, or not positives, but just maybe there's a shift and you say, well, Strive Asset Management, I think they're called. They're the guys who are talking about, BlackRock pushing ExxonMobil to divest of assets while also being a big shareholder of PetroChina. And they're calling them out on, the governors of U.S. states are calling them out on fiduciary duty. And for pension funds, fiduciary duty, for all funds, fiduciary duty is a very big deal. And so you say, well, that's interesting. You see Liz Truss, I think her name is, the new UK PM. She's reversed her ban on fracking that was put in 2019. But I don't see investors coming back to this space in the same way they did, just because the swing against oil and gas has been so big for so long, and the ESG considerations are going to keep it down. And you can see it in the stocks. And the way I'd phrase that to you is, if you have a company that has a 5-year proved producing RLI, reserve life index, and it's trading at 2.5 times, or maybe it's 3 or 4 times on a normalized deck. So you use a lower oil price and a lower gas price than strip if you want to, but you still get a lot of that company for free. And it's reflecting what investors seem to be putting on terminal value risk. And every year that goes by, I don't see that changing. You may see a change in oil versus gas. So you look at what's going on in Europe with the Ukraine and Russia and the delicious comedy of that. From an energy perspective, you could argue that natural gas should trade at a higher multiple, I feel, than maybe oil, just because the people are working so hard to reduce oil demand. And even if it keeps going up, I don't think anyone's going to pay for that. So I feel like there'd be maybe some differentiation between the two, but I don't see a thawing in the capital markets at all for oil and gas. Not really. Maybe at the margin a little, but I don't think it's enough to really make a big difference, unfortunately. And so as an investor, you got to ask yourself, can I invest with a company and I'm not going to bet on multiple expansion? I'm going to bet on them actually adding true value to the company over time, such that I have a per share outcome that I'm happy with.
Maybe it's a good thing in the overall grand scheme of things for the shareholder.
You know what? That's exactly right. So I call it the U.S. Ponzi scheme because, and we did it in Canada too, by the way. You walk into an investment bank in 2010, and anybody could raise $50 or $100 million to go drill a bunch of wells. Doesn't matter what the play, doesn't matter anything. And that's the worst. It's great for the Peters Co. or Goldman Sachs. Yeah. But it's not so good for the business. And when you instill capital discipline into these companies by making them run on a shoestring, internally generated cash flow, they become much, much, much healthier. And they are much healthier today than they've ever been, trading at comically low valuations. It's actually a neat time as an investor, right? So I'm quite happy about it in the sense of how much healthier the business is. And you look at, the marijuana Ponzi scheme, you look at the tech non-cash flow company Ponzi scheme. Like, it's not just oil and gas that goes through these evolutions, but we had our turn and now we're living within our means. And I think it's a very healthy place to be.
Back in 2010, did you look around and kind of think to yourself, this is a little too frothy, or was it just the nature of the industry at the time?
That's a curious question. I used to publish for investors a little investor note, and I had a thing that I called the greasy sales curves, and it was a valuation model. I have a much more advanced version of that, but it doesn't matter. At the time, the thing that confused me was, depending on how I ran the numbers, everything looked overvalued. And at the time I was like, thinking, geez, I think maybe the model's just not as robust as I think it is. And today it's completely the opposite. Everything looks cheap. And so I feel better about the model, particularly, it just tells you where the capital flows are, and they're not in energy necessarily. I mean, they're there, but they're not really what they were before. Look, if you think about a portfolio manager, so you say, well, okay, I'm a closet indexer, which means that I follow, and I've got 2 or 4 or 5 billion to invest. For me to buy an oil company when it's a small percentage of the index, I have capital limits on how much I can buy. Mm-hmm. And because it's such a small percentage of the index, even if that company doubles, it's not going to change my bonus. And that's the most important part for any investor. Like, they all say they're, acting on behalf of their clients, and they are, but, they're paid to make money. And so they will invest where they see the best returns, but also in enough scale that they can get a big bonus. So it's tough to attract the attention relative to the size of the industry as a portion of the index.
You've seen a lot of capital flows and studied the markets for a long time. When you say that capital isn't flowing into the Canadian energy industry or energy in general, what kind of numbers are you seeing? Is it 30%, 40%, 50% less than 10 years ago? Or what? How do you put that in perspective?
Yeah, off the top of my head, I don't have the numbers in the sense of, I guess when you say capital flowing in, you're talking about investors?
Yeah, like the whole industry. We had 10 billion in 2010, and now we have 5 billion.
Maybe I'll phrase it to you this way. So the analogy for me for the stock market is that it's a balloon, okay? Mm-hmm. And funds flow, it's all to do with it's pressure. So funds flow goes into the balloon, stock market goes up. Funds flow goes out of the balloon, stock market goes down. The skin of the balloon is the number of shares outstanding. So in the Ponzi scheme days, we kept increasing the size of the skin of the balloon. And so funds flow was coming in, but it kept collapsing in on itself no matter how much funds flow came in. Today, we are shrinking the size of the balloon through buybacks. Yeah. And there's very little new equity issuance. So the skin of the balloon is getting tighter. This is why I get excited about, as an energy investor, I feel okay about the stocks, even without investor participation. In fact, it's like I said, that companies are healthy and we're shrinking the size of the balloon. I'm okay with that. Mm-hmm. To say to you, how many billions are allocated in the stock market to the energy space, I don't know. I haven't looked at that in a long time, mm-hmm. but it intuitively, it has to be materially less. Mm-hmm. Yeah.
Seems like there's kind of two models evolving right now. The really good energy companies are still pursuing growth, and then the maybe second tier ones are just a different perspective, are doing the buybacks and the dividends. Do you have a preference for either or model, or does it just depend on the assets the company owns and the management philosophy?
Look, like there's 3 ways for a company to grow, right? And we talk about one of them in a different way. One is the drill bit. You can go buy land and drill a well. One is through M&A, and there's a lot of strategic considerations in M&A. And then one is through per share growth via buybacks. And there's all sorts of considerations in all 3 of them. And so I'm really agnostic as to that in the sense of each company, board, management, where are their strengths, where are their weaknesses, and then you hit upon your strategy and try and execute it in the best way you can. And if that means paying a dividend back, if that means growing like crazy because you've got a good play, one of the things you always got to remember with oil and gas companies is, and this was part of the shale problem, the Ponzi scheme, is that you're drilling 80% decline wells. And so the faster you grow, the bigger your problem gets. And I remember 7 Generations was probably the fastest growing company Canada's ever had with the drill bit. And I remember thinking, well, if they get to 500,000 BOEs a day, their corporate decline, they're going to have to replace 200,000 barrels a day every year. And at some point you have to implode because there's not enough services to do the work. So there's some theoretical barrier on decline replacement. So, you choose your growth points very carefully in the context of the bigger company, the underlying decline rate, and then how many locations you have. Like it's a multifaceted thing. And for every company, it's a little different.
How many people do you think understood that or understand that from, say, the past 10 years? Because you kind of had this mentality of the, I guess, capital allocators who do get that. And then all the rest of the industry that services it and works in it. Do you think there's a understanding of what's going on throughout the industry, or is this a very...
I think, I'm optimistic that people have learned a lot. I think there's still skepticism in the investor community that the oil and gas companies are just going to go right back to growing as fast as they can. And like you go back to Spindletop days, first US well, and you got the guy with the white teeth and the white hat and the white belt and the white shoes, and he's selling you on something, right? Like that hasn't, that reputation it's historical. It's not new. And so I think the industry has to be very mindful of trying to permanently shift that mindset such that people understand that there's sophistication in capital allocation and being thoughtful about how we do things rather than just hell-bent growth for growth's sake, because it doesn't work. It will collapse in on itself eventually. So I'm optimistic that a lot of really hard lessons were learned in the last down cycle. Will they be learned by everybody? Of course not. But hopefully the majority hold to the fore. And if you look at the U.S. producers, the public ones, the bigger ones, EOG, Pioneer, they're really sticking to their knitting on the discipline front, as far as I can tell, which is encouraging.
You sit on the board of major energy companies in Canada, so you see the, I guess, strategic moves and all that. Do you think that discipline is here to stay in Canada?
Well, I think you're always tempted to go a little faster.
Because there's a reason that people do that.
Yeah, but there's also the behind the scenes of, is it sustainable, and are you creating problems into the next year in the sense of decline rate? And so I feel like the capital discipline is much, much better for 90% of the companies in Canada. The bigger ones are the ones who matter. And those seem to be they seem to have figured it out maybe much better than in history, actually. Cause you've had I talk about getting your face caved in, which is trading desk parlance, but they've had their faces caved in the sense of lots of hard conversations and going through a decade of terrible stock market returns, and no one's making money on their options, and then COVID. Those are not fun times, but a lot of really good lessons are learned, and that's okay. So I'm optimistic, I suppose, but maybe I shouldn't be.
On the flip side, you kind of go back to that old school wildcat drilling, where the huge discoveries and all that is where a lot of the big wealth was created and the value was made from gigantic finds. Right. And that kind of attitude. Do you think it's a bad thing that's going away in some sense because you're not getting those wildcatters?
Well, okay. So we talked about my view on tightness in the supply side.
Because now the capital allocators are here.
Yeah.
Right.
Yeah. And so you think about it from the board perspective, board of an energy company, and you look at Rystad, they just came out, I don't know, a week ago, and the exploration tally year to date is the lowest since 2000 in 2022. Yeah. It's a pretty healthy commodity market. And, pretend you sit on a board of, BP, somewhere like that, huge company. You're being told by investors that they're concerned on terminal value risk. So are you going to go do a giant offshore project that takes an easy 10 years, probably longer to come to fruition and cost billions of dollars, when your investors are telling you that they're not comfortable with that? it's a real gut check, and you can see it's coming true in the sense of people aren't spending the money on those big projects like they used to. And so that said, you look at Headwater, and again, Neil is the expert on that story, and I'm not promoting anyone on any of the companies that I'm on the board of, because that's not my job. But just to illustrate, Headwater does have a portion of its capital allocated to small E exploration. And if you go and look back at the success to date, I would tell you that I think that's probably some of the best return on capital we've had so far. And so selectively, and that's obviously much shorter cycle, but it's a drop in the bucket compared to what the world probably needs in that sense. And it's just gone.
It's kind of like, thought about it before, the tech industry, it's like this black box. You don't really know if it's going to work, like in the case of Uber or Google or something like that. But when it does, it's the real value creation. Right. That's like the old classic oil and gas industry, Right.
Absolutely. Yeah. So it's a slice of your portfolio maybe, but not too much.
Where do you see the most opportunity in energy these days? Is it the Headwaters of the world, or is it maybe like the approaching 10% dividend rate of Cardinal Energy or something like that? Where would you look?
Yeah. So as a director of 3 public entities, I'd probably stay away from giving you specific stock recommendations, but I think there's a bunch of really neat themes that are out there. And, you and I had spoken a little bit about the Clearwater play. And if you dial back one step, somewhere on this podcast, we speak about scarcity and underinvestment in the oil and gas space relative to demand. And if you think about themes, and you look at various investment banks research, the Clearwater is a play for medium duration oil with growth and exploration potential seems relatively unique. And I say that with the caveat emptor, pick your stocks carefully as an investor. One of the other themes that really does stand out to me, and it becomes a little more nuanced, but you think about the EU talking about natural gas and nuclear actually, by the way, but as a transition fuel. And what that does is it adds duration, and over time it should be multiple expanding. And if you think about how you're opening up US LNG export, post Freeport coming back on, you'll probably be at something like 13 BCF a day, directionally heading to 20 BCF a day, which is a big amount of natural gas that's going to be tied to more to global pricing. And then you have Western Canada, supplying some gas to the United States, but also LNG Canada on stream. Maybe it's end of 25, sometime in 2026. And what that does, or has the potential to do, of course, is you're rebasing North American gas to a more international price. And maybe prices in Europe are a little out of control here in the sense of what Vladimir is up to. But, you can look towards some of the Western Canadian companies, and you look for scale resource. The Montney is a wonderful play. It's got lots of locations and reserves that's probably last decades. And so those are really neat concepts to think about if you're an investor who's acting as an owner rather than just a renter. And I always like to think of stocks in terms of owning versus renting. And owning, you can own some of these natural gas names for a long time and just sit and wait. And again, on this podcast, we illustrated that 82% of the world's primary energy demand is met by fossil fuels today. So if we're exporting some, there's great demand for all sorts of reasons for all types of energy. And I really am a believer in we need it all. Where you can find great joy as an investor is finding something that's mispriced relative to its asset duration. And so when you're looking at, let's pick the mid-cap space, or even an oil sands player, it doesn't matter. If you look at how long the resource has in terms of duration relative to what you're paying today, and maybe you're paying a mid, 2.5 to 3 times EV to debt adjusted cash flow, or maybe it's a little bit higher than that in certain instances, relative to an asset life that could be 3 decades in some cases. And that strikes me as a mispricing. And so from that perspective, that's where I start to look at pricing and as an investor, that allows you to examine plays like, say, the Montney, right? One of the other things that I have looked at as an example, because you think about renewable energy and there seems to be lots of opportunity in renewables. I tell you what, I'm not, like I said, I'm not against renewables at all. I do own some utility entities with exposure to spot pricing. But, I think you got to get creative because it's new businesses in lots of instances. Maybe they don't necessarily have cash flows yet, or there's technological advancements that have to occur, and those are coming. But during COVID, as an example, I used a derivative to make money as an investor. And so rather than, I had all these decks of renewable entities on my desk at some point in 2020, and people were raising money hand over fist at very high valuations. And I just bought Goldman Sachs because I said, well, okay, I'm going to own the investment bank who's going to take no risk on a technology, but they're going to make lots of money as the investment bank. And so, I think you do have to be a little bit creative in how you take these, or how you approach investing in energy. And I'll give you another example. If we're going to electrify everything, so we talked about electrification. Well, you look at how much transmission line expansion needs to occur in all over the world. And one of the things that I want to expose myself to is existing transmission lines. And I'll give you a simple example, right of ways. And so if you think about where the wind blows in the U.S., these readily available maps, okay, where the wind blows in the U.S. is right down the middle, and it's on the coasts offshore. So, the wind kind of blows where the people aren't. And from that perspective, if you're going to really, really expand renewables, say wind, you do need transmission right of ways because you have to rebuild the grid in all sorts of different areas and not just a little bit. And so, that's something that I'm in pursuit of, for example, as an investor, right? Because those existing transmission right of ways probably have an infinite value over the next 20, 30 years.
Do you worry that even though there's lots of opportunity in a play like the Montney or the Clearwater, the analogy is that you're stacking a warehouse up full of widgets that you don't really need, and that even if there is 30 years worth of widgets there, it's really hard to know what they'll be worth then, and you're just kind of bowling blind.
Yeah, that's really fair, and I think that's reflected in the stocks already. In other words, if you have pick a mid-cap entity, and recent multiples, maybe they're 2.5 to 3 times. Okay, so let's take a typical oil and gas producer, and they might have a proved producing reserve life of 5 years. And if I can buy that stock for 3 times, I get 2 years of proved producing assets life for free, and I get all the non-producing stuff for free. And so that's where I look at this and I say, I'm not necessarily betting on multiple expansion to make money. I can invest with good teams who year over year can create value. And that's how the share price can lift. But does that mean that, I ever feel like I'm going to get paid for a 30-year oil sands asset or a 40-year oil sands asset, what it probably could be paid if demand lasts that long? Probably not, but I don't care, right? That's, that's free option upside. If that were to occur for some reason that I don't anticipate, that's okay. But it's not like I'm paying for that today. Does that make sense?
Absolutely. One of the arguments going around is that you're getting like 20 years of inventory for, say, five-year price, but nobody knows what's going to be happening in 20 years. And so I think that's where the critic would come in, and the generalist would say, I don't care because I don't want your 20 years of inventory, even if it is priced at a 5-year cash flow rate.
Yeah. And I think that is a real debate. If you think about humans and their ability to forecast very far out, it's horrifically bad, me included. So I'm on your podcast. Maybe I've insinuated that I've had some good stock picks. Okay. But I only remind you of the good ones. Let's be frank, right? So I've got lots of mistakes in my world that I try and learn from, but let's be mindful of how good we are. And so I'm going to quote from Vaclav Smil, who's a wonderful researcher. And if you think about the list of humans, and I've actually expanded his list, but the list of humans who are really smart, who have said things that are really, really wrong. And so, in 2008, Al Gore said 100% of U.S. electricity from renewables is achievable, affordable, and transformative. And he wanted to have it done by 2018. That was his target. T. Boone Pickens, 2008. He's the, billionaire guy. He said,
rest in peace.
Yeah, we're going to use wind generation to replace natural gas-fired power generation in the United States, again, by 2018. Go further, like that didn't even come close. Carter administration, 1978, 20% of all U.S. energy from solar by the year 2000. Well, that's a swing and a miss, and by decades, okay? GE in 1971 said 100% of U.S. electricity from nuclear generation by 1990. Well, that's a swing and a miss. GE's the smart one in the sense that that's probably the best outcome that could have happened. But if you really sit back and think about how hard it's going to be to transition and the amount of capital it's going to take and the cascading of delays because we're all doing the same thing at the same time, it argues to me, and climate change aside, it gets pretty hot outside, you start worrying. I appreciate that. I really do. But there's also, there's also reality of people wanting heat and cooling and transport, and they want it 100% of the time in the sense of reliability. And so these questions are very, very material. And for me to stand here and say, I know what's going to happen in 2030 or 2040 based on historical swings and misses is ridiculous. It's just ridiculous. But if I can, as an investor, find opportunities that seem mispriced on very reasonable assumptions, count me in. It's an exciting time and it's a volatile time, which means be ready to hide under your desk when you're pressing the buy button, but that's probably the time to do it.
Why is it so volatile?
First of all, demand is there, supply is more scarce. And what that does is it exacerbates small things. And so you've got, and things cascade into one another. And so clearly there's the Russian-Ukraine challenges. You've got drought in a bunch of different parts of the world, which are affecting hydro. But not only that, you're seeing less liquidity in the commodity markets. And, the risk management groups of these banks, I'm familiar with some of them, and they walk around to their commodity traders. And if a guy's offside on a trade, he gets tapped on the shoulder and he is shut down. And in volatility exacerbates volatility, it makes it worse. And so as liquidity dries up, and so we're going to continue to see this volatility, and it may actually get worse before it gets better. At some point, for some reason, it will change and get healthier. But for right now, and think about the trading houses of the world and how much trouble some of them could be on margin in Europe, as a for instance. So that dries up liquidity, and it's that's okay because volatility does create opportunity, but the volatility is going to stay for a while. And is it, a month or 6 months, a year, 4 years? I have no idea, but it's going to stay.
It's easy to talk about all the macro things in energy and whatnot, and everyone likes to talk about it, but it's really hard to predict. Maybe you got it right in 2018, but most economic forecasts are wrong. Do you find it's easier just to pay attention to the nuts and bolts of an energy company and stick to the bottom up sort of stuff?
Look, I like to start at 30,000 feet and then dive into the weeds a little bit when you're thinking about strategy. And I find there's a lot of, I don't know if I'll call you misinformation, or maybe misunderstanding is a better phrasing, where I don't think people on average, this is kind of my life, so I tend to look at the math, okay? I feel like there's a misunderstanding of the energy complex in its entirety. And so if you start at 30,000 feet and then think about how that drives strategy. So we'll do the, part one and part two, but I just pulled up these numbers the other day because I was curious. Global energy demand is up 50% since 2000. 50. It's a huge number, right? The renewables, but you think about, everyone's talking about electrification. Electricity as a percentage of global energy consumed is 17%. So what I would illustrate to anyone on this podcast is the scale of the problem. And that's why we go back to the start of this podcast. I said, we need it all. You do need it all. You need tons of it. Everything. We're like, hurry up. Hurry up. We're going to have social unrest and like protests and people going nuts over energy costs as, you know, we're destabilizing the system from a bunch of different directions and not investing enough. And we're heading into I feel like there's a real time of scarcity that we probably haven't seen for a long time coming on a number of different places, energy and otherwise. And so we'll be mindful of that as investors as well, right? So it's a curious time. But then you take those statements that I just said and say, well, okay, you know, as a board member, how do we think about strategy? Yeah. How do we think about creating something someone else wants to own, be it a shareholder or another company? Because that's what you should do, is capital allocation. Think about those strategies. Where do you want to be in 1, 2, 5 years? And hopefully that turns into a great outcome for shareholders.
Eric, not all told me it was the fear of peak demand is leading to the reality of peak supply.
Right. Yeah, it's a great phrasing. And we talked about the lack of capital there, right? Mm-hmm. Yeah.
And almost like the road to hell is paved with good intentions.
Well, I think you're seeing that in Europe to an extent, and you're seeing that in California to an extent, right? With the instability of their grid, you know, they've gotten rid of gas-fired electric generation. They've gotten rid of nuclear, which is comical, and now their grid is unstable, and they're having blackouts. Because there's not enough batteries on Earth. Bill Gates, right? There's not enough batteries on Earth to power Tokyo for 3 days. Mm-hmm. Okay. Mm-hmm. So again, it comes back to scale. How are you going to get through this energy transition if that's what we've all decided to do? How are you going to get through it without all sorts of social unrest? I actually don't know, you know, and you look at the mistakes Germany made, sidling up to Russia. It's really coming to the fore. I mean, Germany's burning 1/3 coal, as of some newspaper article, you know, the other day.
Just to keep the lights on.
Just to keep the lights on. Yeah. Oops. Right. We had great intentions. We're okay. Well, you've made a terrible bet. You should, you know, Gerhard Schroeder in 2004 or 5 was on the board of the joint venture with Nord Stream and complimented Putin as a great free thinker or whatever the quote was. Well, that didn't work out so well. And then Angela Merkel freaked out over Japan having a tsunami and shutting down their nuclear. Like, those are really great choices. And I'm not throwing rocks. I make mistakes all the time, but it is very illustrative of, you know, your point on good intentions. Is she's a brilliant lady, great intentions. The outcome was different than expected, right? And so those are, it's a curious time, and it's exciting. I mean, lots of money is going to be made and lost, and lots of volatility. So be mindful of that, right?
Yeah. Lots of money being made right now in the Canadian energy industry with record profits, and the Alberta government record profits. Yeah. Even last summer, it was still kind of rough times, even last summer. Now it's total 180. Yeah.
Right. Yeah. And you also mindful of that too, right? Because bad times can come again. And so when you tie that to corporate strategy, you got to be really careful. And when I say careful, you know, equity is precious for a given entity. Okay. You have to treat it with great respect. You treat your balance sheet with great respect. You treat your staff and people and culture very carefully. And then when and if things do go sideways, you're well positioned, and that can be a great outcome. And you look at what Neil and his team did at Headwater, buying an asset when things were as bad as they could be. And by the way, same thing at Topaz. Mike Rose and all that brilliance ties into Topaz's execution when there was very little interest in the space, and you could put your arms around really interesting assets at a good price. So there, crisis does create opportunity. So bring it on. Like crisis is okay.
Another thing you wrote about was these emerging technologies that have actually increased energy demand, like Amazon, Airbnb, Uber.
Yeah. Yeah, we can walk through that. I don't have the article. The article was written in 2018, but it's just as relevant today. And, maybe to highlight for people like the point we were making was, the iPhone was invented in 2007, right? First one came out. But what it did was enable. And so you've got, this is just one illustration, but you've got Airbnb starts up and they end up being bigger than the 5 largest hotel chains combined without spending any capital on rooms. Okay. What that does is it increases supply. So then it lowers cost. You have increased airplane efficiency, lowering cost. And so some guy in some country who's never been on vacation and now has a phone can book a vacation quicker and at a cheaper cost than ever at any time in history. And we talked about efficiency. You just enabled some family to fly halfway around the world who could never do it before. And that increases energy demand. And it's not the fact that you're plugging in your phone at night that creates energy demand at the margin. That's irrelevant. It's the fact that every time you press a button or take a photo and store it on the cloud, they call it the cloud as these giant facilities using electricity that could be used for other things. I think my family has 100,000 photos and videos that we never look at sitting on the cloud somewhere. I'm not helping, right? Shouldn't we all just delete all our photos? I don't know. Do I need 80,000 photos of my kids?
Yeah.
Probably not.
Yeah.
But you start to understand or illustrate how at the margin technology really does push energy demand. And if they're using green sources to fund to fuel the cloud building, that's still electricity that could be used for something else that we need, right? I don't need 100,000 photos. I don't need that extra vacation maybe as much as I think I do. And so, that's just the state of the world, right? And one other thing that the article pointed out was, the data from automated vehicles, 1 year's worth of data would overwhelm the current storage data capacity in the US at that time.
Mm-hmm.
And so data storage, it's a massive energy use, all enabled by technology. It's great. Like I love having a supercomputer in my pocket to answer all the crazy questions my kids ask me that I have no idea. My dad used to just say, it's magic. Whenever I ask a question, it's magic.
Yeah.
But now I can actually give them an answer and it's pretty neat. But, you're also using energy every second of every day.
Or the Amazon package that arrives 24 hours later.
Well, yeah, that's another one, right?
That's magic.
Yeah, you go look at U.S. trucking miles and the correlation to Amazon revenues. It's pretty tight.
That was another thing you commented on. Yeah.
Yeah, and maybe that's changed, and I'm sure Amazon's going through its machinations trying to improve things, but it's just all of us doing stuff, and there's lots of us. And again, like energy efficiency makes demand go up. There's many, many articles on that. Does behavioral change, systems change? These things can and will occur, but the scale is just so staggering. It's almost unbelievable. And that's before you get through, government policy and NIMBY and things like that.
Was there ever a point you were worried about the energy industry being sunset, or did you know kind of all along, or did you take a lot of research and homework to figure this all out, or how did you come to that conclusion?
In 2017, I think it was 2017. So I retired away from Peters Co, and I was involved for a little while, I was involved in a private equity shop, and I told you, being a podcast, my wife got a little sick, and I stepped away from that, but we were really trying to figure that question out, exactly what you just said. And so then I went and started doing a lot of math and research with the help of the team there. And that's where I first came to the conclusion we need it all, because it's comical. I hadn't appreciated to that point, despite being a Peters Co guy and looking at energy all the time, I hadn't appreciated how comical everything is, and the laundry list of things that need to be done to get through this. And the time is it's immense. So yeah, that was when the realization hit me.
How does inflation tie into energy from your perspective?
Yeah. So, I told you I only brag about my good calls, right? So one of the calls I made, although I'm not in print for it, it was just as an investor, was during August of 2020, I got really concerned about inflation, and it was because of the money printing that was going on and my knowledge of energy transition concern in the sense of scale, pace, and cost. And just to illustrate the events of COVID, the United States from Feb 20 to December 21 increased their M2 money supply 39%. Okay, so let me get this straight. I have a 246-year-old country that within a very 1% of their existence, call it, printed 40%, almost 40% of their currency outstanding. Like, it's not Zimbabwe, but that's a lot of currency to be printed. And so then you tie in all the other things. So I would be in the higher for longer camp. And I appreciate that Canadian and US inflation, maybe it's peaked, okay, because commodity deflation, you had oil go from, maybe it peaked at $120 recently, and it's, notionally 80 Yan dollars today. But let's walk through this. So perspective, energy, in 2008, which was prior to the GFC, the Great Financial Crisis, there was 3 big oil sands projects underway, and to a man, they were 100% over budget. And it's because they were doing the same thing at the same time. And one of the companies I distinctly remember, they missed we're going to talk about what delays do to costs, but they missed their startup date in the fall, and they had to run heat tracing, which added $100 million. Heat tracing, just to keep it warm enough to start it up during the winter, added $100 million to their project. And now you take that micro economy, Fort McMurray, and play that out across the globe. So if you say, well, everyone wants solar, everyone wants wind, everyone wants all this stuff, they want to redo their infrastructure, they want to build new roads, they want better water infrastructure, they want desalination. There's just an order of magnitude, many orders of magnitude higher capital activity. And that just speaks to me thinking, good luck. And I know technology can be deflationary, but this isn't an iPhone. Solar and wind take steel and cement and all sorts of rare earth type materials, which are not in great supply. And if I want reliability, you go look at California, they've taken natural gas fired power off, they've taken nuclear offline in favor of wind and solar, and they're seeing grid instability. And if you think about energy security, which, the US has long talked about, Europeans kind of forgot about. Vladimir has brought that back to the fore. Mm-hmm. But rare earth materials, which are required for all sorts of renewable type technologies, China notionally controls 60% of the extraction and 90% of the processing. So there's risk in the global supply chain there. All that says to me is costs more, takes longer. Like, we got to reshore it to Canada. We got to reshore it to America. Is it going to be cheaper? I don't know. I'd bet that it won't. Mm-hmm. I don't know, because the permitting, the NIMBY, people are going to fight, even if it's for a really clean battery facility or whatever. People just fight it. And there's a great article in the Financial Times talking about how environmental permitting on average in the US now is 3.5 years. And so if you want to get anything done, it's just going to take time. One of the other things that I think really matters, like if I was going to start a blog tomorrow, which I will not, okay?
Probably should.
Yeah. If anyone wants to start a blog using this title, go for it. But if I was going to start a blog tomorrow, I'd call it Being Nice Costs Money. And the governments of the world, and I'm picking on Canada and the United States, they're trying to be nice, okay? But what it does is it causes inflation. And Canada came out with this dental plan. And let's just use it as a story. So you have this dental plan, and it's being nice to Canadians who don't have dental coverage. And if my kids didn't have dental coverage, I'd be pretty excited about that. Like, it's a nice thing to do. Okay. But there's no incentive now for dentists to cut costs because the federal government's backstopping it. So you just told me, I'm a dentist. You just told me my business is getting really, really, really busy and I can charge what I want. Ooh, what's the good in that? Like, there's no incentive to bring costs down. It's a little bit like the GST tax credit. The analogy in the US is the student loan forgiveness program. Forget the day-to-day of the student who hasn't got to pay off their debt. It's the fact that a Harvard, or like if I ran Harvard, I'd be phoning my board and saying, let's build a new football stadium because we can jack up fees this fall because the U.S. government's paying back all the student loans. It's sold to me.
Yeah.
And so these acts of being kind that the government is doing to get votes become very expensive in the sense of inflation and the impact on the purchasing power of the commodity. There's another thing that's going on the inflationary front. And there's global coincidental drought, right? You see it in the newspapers, and we don't have to go through it in a ton of detail, but Southwest US, right? A little bit in Alberta. Alberta's always a bit dry. You've got, drought in China that's affecting hydro production. You've got drought in Europe that's affecting ability for barges to go up and down the river. You've got drought in Africa and the Middle East. And the only guys who are managing their water well are the Israelis, who saw this coming 20 years ago and built out desal. Okay. They're brilliant, by the way, as an entity managing their water, but everyone else isn't really there yet. And so the farmer who needs to transport water to his thirsty cattle, you use the lake that was on your property that was free, and now you have to transport water in. Well, that bleeds into the food chain system and inflation. It just occurs. There's another element of this too that is current, and that's the war. The U.S. is, I counted up on the weekend, the U.S. has spent $53 billion on Ukraine, and that's money that just gets torched. And I think, Canada's done its notional 8 to 10% of that, like similar on a population weighted basis, I think. And in the vein of being nice, if the governments aren't cutting elsewhere, they have to effectively print money to do it. And so that's where this all ties into are we going to manage inflation and bring it down? Yeah, probably. Big recession, rising rates, those sorts of things. So I don't think inflation is going to go, to Zimbabwe-like levels, but I would be in the higher for longer camp because it's a different world than it used to be. And a lot of actors are involved in making sure that it probably does stay higher for longer.
Increasing money supply, generous governments, drier climates all contribute to inflation, which means higher energy prices. Long story short.
Well, I guess this ties to earlier or somewhere else in the podcast, depending on what order you print all these answers in. But, we talk about, I'm a buyer of weakness on energy generally. And I think the volatility is going to be very high. And yeah, you know what? You tie it together with what we talked about on supply scarcity in oil and gas and frankly, other commodities. And you start realizing that maybe it's not such a bad place to have a little bit of your portfolio weighting.
Well, that's an hour.
Wow. That flew by, eh?
It's really easy to talk about this stuff.
Yeah. Well, you're right. I mean, I'm sure my wife would be long passed out by now, but I enjoy this sort of thing. So thank you for having me. It's good stuff.
I really appreciate it. On that note, we'll end it. Thank you.
Oh, thank you. Appreciate the chance.
That's it. Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.